right, we are in for a wonderful conversation today. I've got David Zapata, one of our key partners here at Factum, as well as Wade Borth, and we are joined today by the one and only Todd Langford, who is the creator of the Truth Concept software that we all participate and we use to build our courses, because we know the math is vital to understanding the benefit behind whole life insurance. And so today we are going to be addressing a very common misconception. And that first misconception that we're going to talk about today is the commissions on life insurance. And one of the things that I've heard in the big wide world, Todd, from very, very high profile leaders is that life insurance is the highest paying gig out there. We hear this one a lot. Insurance agents are making crazy commissions, 50%, 100%. And I'd love to be able to break down this conversation as an educational piece for our database, our clients, just so that we have more clarity and better perspective on how to actually calculate this industry to industry.
Sure. So, thank you for having me here. It's a great opportunity to be able to talk to people, tell the truth. That's always fun. And, in this arena, what we hear are numbers that are taken out of context. And that's what happens most of the time. I would say most of the misinformation in the financial industry, which you think about, it's based on math. How can you have misinformation? But a lot of times it's because it's taken out of context or the wrong formula is used. They may be even using the right math, it's just the wrong formula. And so the problem with that is that when we look at life insurance commissions, what everybody hears is, so like a base commission is 55%. Well, it's 55% of one installment, and people want to compare that to 1.5% or 2% in their equities account. But the 2% or 1.5% is on the whole pie, and it doesn't stop in the first year. And so there's a drastic difference in what those are. And so people are 55 versus 1.5, and it looks like, wow, the commission is huge on life insurance. But again, that's just on one installment instead of the whole pie.
Wonderful. So let's break this down. David, do you want to pull up that calculator? And Todd, would you just walk us through some of this math? And while David's pulling that up, one of the points that I want to make that I always found interesting is it's kind of a crazy conversation in general that we hear from maybe the real estate side, which is where I heard it a few weeks ago, that insurance agents are just paid these astronomically high commissions. And I want to take a step back and one, why are we comparing industries that have nothing in common with how they're getting paid, right? Like we wouldn't take a doctor and maybe a PE teacher at an elementary school and say, these doctors are crazy overpaid. Well, it's a different role, responsibility, not saying one's better than the other, but you really can't compare those industry to industry. But we're going to give this our best shot right now, just to kind of level the playing field and just educate people on how exactly we get paid versus maybe real estate and a financial advisor managing funds.
Sure. So here we look at a $15,000 base premium for some life insurance. And if we look at a 55% commission rate for the first installment, again, there's multiple installments, so this is just on an installment, that's on the first premium. And then even with a 10% per year renewal commission for say 5 years, then that's what this would look like. So we see that this tops out at $16,136 at the end of that 5th year. That includes the base premium plus those subsequent renewal premiums. All right, and this is what people see as high commission because we put in $15,000, somebody gets $8,400. All right, but again, like I said, it's taken out of context because it's just on this piece. So let's look at what would happen from an investment standpoint. And I'm going to look at, say, a bond fund. And so if we put this in here on an investment on the next one down of, let's call it 4%. And then let's look at a 1.5 management fee. So typically the comparison is 55% versus a 1.5. But yet when we look at the bottom of this, the cumulative fees on that 4% bond at a 1.5, that account manager got $138,000 over that time frame versus only $16,000 on the whole life side. And so, one of the things we talk about sometimes is, when is 1.5% more than 55%? That's kind of a weird conversation, but that's really what's happening here. And people get hung up on the wrong piece. And if we look at the orange versus the green, we can see that the life insurance salesperson actually in cumulative commissions is ahead for the first 10 years. But then look what happens on the right-hand side with the 4% bond account. There's another piece here that I think is really important. And does the commission matter, or does, for the client, the maximum amount of value matter? And what I mean by that, if you look at both of these, let's say hypothetically that the life insurance guy did get more commission than the bond manager. Well, would it matter at the bottom if you had $814,000 instead of $674,000? So it's the wrong conversation, right? There's another piece to this that I think is really critical, and that is, with life insurance policy, what we see on the numbers are already net of the commissions. That's very different than the way we hear bonds or equities or any other thing, in that we're hearing the gross return before the commissions. So what we have to look at is taking the commissions out to actually finding out what the real return is on that alternate choice. With life insurance, it's already included. It doesn't matter what they are. They don't impact what the client gets along the way. They do impact it, like in this case on the bond side or anything else. And so again, we look at the bottom line, the really important thing is the client going to be better off? Who cares what the commissions are if the client's better off in one scenario than the other? It turns out that with life insurance, which is always dinged as having terribly high fees and commissions and all that, actually has the lowest commission and the highest return. Pretty crazy.
With all the certainty. And so, Todd, I'm not going to say retirement accounts or investment accounts are right or wrong. I had a Roth IRA set up for me when I was 16 by my grandfather. And I worked during high school and I saved a lot of money and I put it into that environment because he said you could retire by the time you're 40 if you start now. And I graduated high school in 2007. And when 2008 rolled around, I watched 40% of my Roth IRA value disappear.
Yeah.
And at the same time, I don't know who the guy was that was managing my account, but he still got paid a management fee, even though I lost 40% of that value. And so I'm not going to say he was good or bad, but for me, there was an internal issue with that where I was not okay with someone losing that amount of money for me and still getting paid. I think there's very few professions in the world that you could get away with that. And when we're placing a life insurance contract that has guarantees built in for an entire life, there's that conversation of certainty that I think people get confused. And it's why we put whole life at a foundation conversation, really as a savings environment versus an investment grade vehicle that's going to have some risk. And this is why we'd always recommend not having the or conversation, but like get the certainty and the protection of the life insurance to support your investment strategy if that's the right fit for you. But unfortunately, these things get put level to level, and then we compare a savings environment with an investment grade vehicle, and we compare the commissions and everything else the same way. But this type of example, at least for me, is so helpful to see what's going on behind the scenes with the numbers.
Yeah. It's a critical piece that's just left out everywhere, right?
Yes.
Yeah. Hey, Todd, thank you for doing this. This is so valuable. One of the things I look at is when you get the delivery of value. Right. So people know the price of everything, but they, rarely do we have an understanding what the value is. And so sometimes we get paid for when we deliver the value.
Yep.
And so even somebody that's doing an investment account, if they're managing the account, I'm going to put management in quotes because a lot of times they turn over to somebody else. But if they're managing an account, when does that value come? Where, I think in the insurance world, we see value delivered immediately.
To add to that, and going back to what Kyle said as well about the management side of that, and looking at the Roth, but think about this in that qualified plan arena where the money's being managed, like your 401k or 403b or any of those. What happens when the business, the employer, gets a new management firm to handle the accounts? Now then, a lot of those accounts get sold off because the new firm doesn't have the ability to have the same fund capabilities. Is the fund going to be at a high point or a low point when they do all those sales to rebuy at another level? So it could be devastating for somebody who has no control over it. The employee has money sitting there, a new fund manager comes in, they don't have the same things available. We have to sell all those off and buy new. And if it's not at an opportune time in the market, what happens?
In the great case that is actively managed and there's some thought through it, but what if it's just buy every Friday and sell when I need money?
Yeah.
The option, right? I just wanted to throw one thing here, which I love about this calculator, Todd. Thank you so much for being here with us. There's an elephant in the room that a lot of people do not recognize, and is this: percentage conversations can be misleading because we don't know how we're using the percentages with respect to what. And I love that when we get to the bottom of it and we turn percentages into actual dollars, the truth is the truth, and there's no more conversation about that. Whether it's 1% or 55, the truth is that here in dollar terms, the commissions for whole life are significantly smaller than what active managers get, because it is not on an ongoing basis. It's not taking a bite of the whole pie every year, every time that you bake a new pie. It is only a percentage of a slice of the whole pie. And the last thing, and I'll turn it back to you, is a quick sanity check is this. We hear this message about commissions being the highest in the industry from active managers and other people that have the interest of controlling people's money. But the truth is that if the whole life product had the highest return from profitability, those Wall Street companies will sell whole life because they're in the business of maximizing their profits. This is not an argument of virtue that we're doing the best for the client. Is the fact that whole life, when you put it in terms of dollars, has a set amount of commission because it's the cost of acquisition for the insurance companies, and it's not going to be greater because it's not on a whole pie and it's not on an ongoing basis.
Yep. What would be interesting, well, let's do this in a couple different pieces. Let's take this, let's put a cost of money, because see, one of the things that we violated here in financial math is we're looking at over time, and all we did was add these up, right? You can't have a valid number really when you look at it at a time and exclude the time value of money or the opportunity cost, whatever you want to call it. And so you think about it, this money is worth a different amount of money. If we go down to the very bottom where we can put a cost of money, and let's say our net value for dollars, what we would hope to earn or what we have in cost, is 4%. Then when we look at that, look at the difference here. $50,000 is what the advisor, that was the value of that, versus $204,000 for the fund manager in this case. And yet the life insurance guy is the guy that makes all this money that he shouldn't make, right?
Yeah.
I think that's the biggest point here, Todd, is people take the time out of the conversation. And one of the things that I've always picked up from you the last 5 years coming to your Truth Concepts training is we have to ask better questions. So if whole life insurance or life insurance is the highest paying gig out there, like we have to compare it to what and over what time frame? Because if you're talking like 3 to 5 years versus actively managed money, 100% we get paid more, but it's not called 3 to 5 year insurance. It's called whole life insurance. It's meant to be in place for your whole life. And so when you take it out to where it should actually be, that's when I think people take a step back and they go, oh, this is actually very good for my expenses to work with a good agent who's going to build a relationship with me long term, because he gets paid basically one time, maybe a little bit of renewals, but it's in my best interest to still serve that client at a high level. Whereas I would actually love it if the wealthier my clients became, the more I got paid. That would be a good win-win too. But you know, we're going to do the best job for what we have, and we focus on bringing that certainty to our clients' lives, which is a vital part of someone's portfolio.
Well, it's kind of interesting that you bring that up just because we can't do this next step that I want to look at. But what if, as a life insurance advisor, you were offered the opportunity of either 55% on the first installment or get paid the same way as the equity side is, and that is a piece of the pie every single year instead of getting that up front? So what if you were able to get 1.5% each year on the cash value? Now, you can't do that, but it's in here just to see, and look what would happen. If we got paid the same way they do, we'd have a lot more money at the end, right?
The interesting part to the Todd is because of the guaranteed elements of the policy, which makes it so unique, that's what throws it into a different asset class altogether, which is why it's so hard to compare whole life to other things. But unfortunately, people do, and that's why there's so much confusion. But if we were able to take a 1% management fee, obviously I would want that for my family all day long. But that's also attached to a guaranteed asset with an insurance company with a 150-year track record of success, versus going to the stock market where we know most financial advisors, nothing against them, they're not even beating the S&P on average. So the certainty and the uncertainty.
Right. And that's a tough piece because, see, with life insurance, it's got that certainty piece in there. And as you mentioned earlier, it is not an investment asset. It's a place to hold, store, grow cash, along with other benefits that it has to make sure that what you're doing actually comes out in the form of guarantees, right? Guaranteed growth on top of a death benefit if something happens and you're out of the picture, and also potentially a waiver of premium disability benefit that would continue these payments of the life insurance policy if you are totally disabled. So it's got these other benefits along with it. And when we look at that out there into the future, the other assets have to have some sort of certainty asset with them. So what I mean by that is you go buy an equities portfolio, most of the time, you're going to have a certainty asset in the form of bonds with it. Now, what everybody hears is only the 8% side that they think they can do in the equities from now on because they've got a good history of that in the past. Nobody includes that point that, yeah, if you buy that 8% equity, you also have to have an anchor of a 4% bond. And that anchor of the other assets are anchors because they're not growing at 4%. It's 4% gross before the commissions and taxes are included in it, right? And so even though you may look at your equities and see those doing 8% or 9% or whatever it is, when you combine it with the certainty asset that you have to have, you probably aren't doing but 6% or so at the top end, gross, before fees. And so one of the other places here is we can look at real estate commissions. So a lot of times people, it's another place where commissions are kind of deceiving a little bit. 6% on real estate commissions. Well, that's a whole lot less than the insurance guy getting at 55%, right? Well, maybe, but it's on a different number. It's on the whole value of the house versus the installments. And so what we have in this lower piece, if we put in a real estate mortgage rate, let's put in 6%. It'll automatically calculate here for us in a minute. The term, let's put 360 months. And it's going to calculate, after we put in a down payment of 20%, that for that same $15,368 premium to life insurance, if we were paying a total of $15,000 a year to our mortgage payment, it would buy a $13,000 mortgage that with the down payment is actually a $256,000 piece of property, right? So if we put a real estate commission in here of 6%, then here is the commission, $15,360. It's increasing by 4% our cost of money. And look at this. It's about the same. It's slightly more actually than what the life insurance agent's getting. But people confuse, again, just like they did on the equity side, 6% of the whole piece against an installment, because the life insurance is 55% of one installment. And so really, the life insurance commissions are pretty similar to what real estate is.
Yeah, and I think that's the big aha, is because I have my real estate license and I used to sell real estate, and the standard commission rate for a real estate agent is 6%. Now, one of the things I think people would say, well, I'm only getting 3 because I'm representing the buyer, right? Well, that'd be the same conversation if, David and I were splitting a case 50-50. But if you're a really good agent, you'll probably get the buyer and the seller more times than newer agents, which the total commission would be 6%. So that 15,000 that's paying out on that sales price is getting compared to the 55% on the installment, which is, I think that's what most people have to understand. We don't get paid a percentage of like the death benefit we sell. We get paid a percentage off the premium, which would be closer to like, what's the individual's mortgage payment? And they get paid based off of that, right? And so when you look at these comparatively speaking, I'm going to go back to the time conversation too, because nothing against industry to industry, but when I sold real estate and that transaction was done, it was done. That home buyer is not calling me as soon as that transaction's done. Now, if I'm a good real estate agent, I know a lot of them, they would answer the phone, answer questions about this or that, but that transaction is completed. Now, if I want the repeat business 5 to 7 years later when they buy and sell again, I want to stay in connection. The difference with what we do on the whole life side is when I place a policy for a family, a client, I am obligated to take their calls and help them service that policy forever. And so I have to build that into my business model to make sure when they have a question about a policy loan in year 7, in year 30, they want to change the payment mode, right? Imagine an individual saying, I need to reduce my mortgage, I need to increase my mortgage, and you had to take that call as the real estate agent the whole time. That's what we're doing on the back end in the life insurance business, and we're getting paid this much to do that. And so seeing this is, one, it's incredibly helpful for me, but I think it's going to help put things in perspective in the right light so that we can see it on an equal playing field.
And that's the big part of what has to happen. Everything in the financial industry, I think, is on different playing fields, right? It's gross to net. It's just a lot of confusing things. So we look at life insurance and we see it, it's only earning 4.5%. And yet people are excited about bonds doing 4.8% gross. Well, that's not the same conversation. If you net down the bond side, you're looking at 2.5%. Why are you excited about 2.5% and not excited about 4.5% net growth over time with a life insurance contract? And it all comes down to the media and the way it's talked about, and just that misinformation that exists in the financial industry. And the unfortunate thing is the wealthy people have the resources, the ability to really dig in and see how things work. And the result is most of them have life insurance as a huge piece of their portfolio. And so who really gets hurt are the people that don't have that capability, the general public. So the masses are the ones that really get injured by the incorrect information that's bombarded, that they're bombarded with, like every day, constantly.
Yeah. Well, one last comment to that thought, because I think time is such an important thought here. Think about the amount of time that we get to think about that net 4% on the insurance company to how were we talking about bonds in 2012, 13, 14, 15, 16, right? What happened when Bernanke and our friend Jay Powell had ZIRP policies and zero interest rates, right? What is going to happen in the future? We don't know. But I do know for a fact that I'd like to make that net a forever asset to hold my savings. And I love to do that for every family I serve versus the volatility of the market.
And the last thing I'll say on this, Todd, is you touched on it earlier, but there's a permanent guaranteed death benefit attached to this product, which is the main purpose that we're in this business for, is to serve and protect those families. So the real estate, the investment account, those don't have a guaranteed death benefit if something were to happen 5 to 7 years in. Right. And so that's the other piece that's so hard to compare these, which is why I started this conversation with the comment of why are we comparing industry to industry commissions when they have nothing in common with each other? We need to take a step back and just be able to really think about this so that we don't jump to conclusions without enough education to make the right decision.
Yeah, you know, and really, it's the stepping back that's so important, and really looking at it in the right perspective. People get hung up on the wrong thing. We see it from taxes. People are so afraid to pay taxes that they overpay something else to avoid or just temporarily put off some tax. And so it's just the idea of not stepping back. And we see the same things with returns and commissions. And look, the bottom line is this. Let's say that I made $1 million off of you in commissions. If you end up with more money than you would in the other options, do you care what I made? It really doesn't matter, and yet that becomes the focus. And the real irony is the life insurance advisor probably makes the smallest commission most of the time of anything out there.
Which is the exact opposite of what we hear in the big wide world, which is life insurance is the highest paying gig out there. And so this has been tremendously valuable, and we've got a lot of courses and resources on our website, factumfinancial.com. I know Todd, the creator of Truth Concepts, one of the brightest minds in our industry. This is why we go to his trainings every year, because once you know the math behind the story, you can start making better, more educated decisions and really start thinking for yourself, because the last thing we want to do is tell people a blank statement and just want them to believe it versus showing them really what's going on so they can make the best decision for themselves. So you can also go to truthconcepts.com. Todd's got a lot of resources on there. They have videos on YouTube that I used to study for hours and hours to learn all this stuff earlier on in my career. So make sure you utilize all of those resources to get the best education, the math and the numbers behind the story so we can make better decisions.
Great, thanks. That's the biggest piece, really, is getting people educated, right?
That's it. Education. With enough education, we can get people to think, and they'll make the right decision based off their unique goals and vision for life. Awesome. Thanks for being with us today, Todd.
Thanks for having me. It's a pleasure.